So you're interested in the stock market. You're interested in wondering how nurses, teachers, graphic designers, electricians have taken very average salaries in the grand scheme of things and turned them into multi-seven-figure portfolios, retired earlier, got out of the rat race and started doing things they enjoyed. And if you are interested in learning everything you need to know about the stock market, you have come to the right video. I have been investing since 2009, and back when I started investing, the markets in general kind of felt like a secret club. I mean, back then you still had to pay at some brokerages $25 a trade. There was no fractional shares. You had to buy whole shares of companies. There was no getting started with $50 because a $50 deposit, often a single trade, would eat up at minimum 20% of that $50. There was no slick apps like we're seeing with Robinhood, like we're seeing with Wealthsimple. It was really an old school time. And back when I started, you couldn't just hop on YouTube and see the massive guide I'm about to give you on getting started with investing. I had to learn it the hard way, which ultimately resulted in a lot of hard lessons learned before I got to the point where I'm at now. And you can avoid all of this by watching this guide. So I'm going to dive into the intricacies of the stock market from start to finish so that by the end of this video, you will have a very firm grasp on how to get started in the stock market, and realistically, by the end of this video, you could be purchasing your first stock in under an hour. And before we get started, there is a resource in the description, a free checklist when it comes to investing in stocks. It's going to give you a broad overview of what you should be doing in regards to your research. Eventually, this will become second nature. You won't need to refer to this as much, but I'm going to drop that in the description because it is going to help you save hours of time, especially when you're first starting out. So you can grab that absolutely free. And as always, I appreciate the likes, the subscribes, and the comments. Drop a comment. Let me know what you want to see from me next in terms of educational resources. I'm very happy to provide more videos like this, but let's dive right into it. So first things first, why should you care about investing? So when I started investing back when I was 19, back in 2009, investing was often considered a rich person's game. I mean, to some degree, it was just considered an outright scam. And what this was is we were just exiting the financial crisis. So the markets took a big downturn after everybody got involved in them from, 2006 to 2008. A lot of people lost a ton of money and they believed it was just an outright scam. And if I didn't listen to these people, I could have easily had the exact same thought process. And one of the main reasons that I knew I was so interested in the markets is, first off, I looked to historical returns and I understood that, as a 19-year-old, I didn't really care where my portfolio was, my overall net worth was in the next 5 years. I wanted to know where it would be in the next 20 to 30 years. And I just knew that the market over time has provided that type of wealth generation despite how bearish people were on the markets in general back then. And another reason I cared so passionately about investing is I just knew there was absolutely no way I was going to save my way into retirement. I mean, even if we think of an average salary of around $80,000 a year, it's a safe assumption that we're going to lose around $20,000 of that to taxes, give or take, depending on where you live. And then we're probably going to lose another 30% of that to just overall living expenses. I mean, and this doesn't even include recreational expenses like going to the movies or things like that. I mean, on an $80K salary, you would be very lucky to be left with around $20,000 to save. So let's assume you saved all of that every year for 30 years. So you'd have $600,000 left over. You will never retire at that rate. You just won't. You can't retire off $600,000, especially when we consider the fact that $600,000 in 30 years will be worth a lot less due to inflation. It's just not a feasible goal. However, this is going to be the number one area of this video where you're going to learn to care about investing if you were on the fence about it. And let's say we take that $20,000 and we invest it in the market and earn 8% a year on average over the next 30 years. You will end up with $2.8 million, which if you're in your 20s and you do this for 30 years, you can effectively guarantee you're going to be sipping margaritas on the beach somewhere in your 50s. You're going to be retired. So this is why you should care about investing. It is literally going to shape your financial future in your later years and is why you should really start to understand the value of money earlier on in your investing career, earlier on in your life, because it can literally shave off decades of your working career. Now, why else should you care? And that is because of inflation. I had quickly mentioned it before, but if we go with average inflation, a $50 bag of groceries you bought today will be worth double that. It will be worth $100 in 30 years. And this is assuming normal levels of inflation. You simply cannot park your money in a savings account and expect to get ahead. In fact, you're probably going to lose purchasing power overall. Inflation is like dumping water into a bucket with a slow leak at the bottom, with the water being your money. If you save the exact same amount of water every year and dump it into that bucket, the level will never get higher because there's a slow bleed at the bottom of it and you will never get ahead. And that is inflation in a nutshell. And that is exactly why you need to be investing. So how exactly does investing work? Now you know why it is important. Now I'll teach you how it's possible that a 20-year-old can throw $100 a week into the markets and be a millionaire by the time they're 60 years old. This seems very far-fetched, but it is definitely very realistic. So what exactly is the stock market? It is a publicly traded market where shares of public corporations trade. So when we think of private corporations, those are ones that are not on the markets, not on the stock market, where a publicly traded corporation is a company that is available for everybody to buy. Absolutely everybody has access to buy a company like Apple, a company like Microsoft, Google, Amazon, things like that. So these are publicly traded corporations and they trade on exchanges. The one in Canada we would see is the Toronto Stock Exchange. In the US, we would see exchanges like the New York Stock Exchange or the NASDAQ. So by buying shares of these companies, you are buying a portion of ownership in that company. Now, it seems a little, minuscule to be buying a $200 share of a company that is worth, say, trillions of dollars. But over time, as you continue to invest more and more, your ownership level in those companies will go up. Now, you will never own a substantial portion of a company like, say, Alphabet. Very few people do, but remember, your shares are proportional ownership, so it does not matter if you own $10,000 in the company. If the company grows at a 10% pace every year, your money is still going to grow. Now, because you are part owner of these companies, you have a direct proportional ownership to that company's earnings. And I will get into this later on in the common metrics, but if a company has earnings per share of $3 and you own one share of that company, those are your earnings. Now, that doesn't necessarily mean you will just get $3 a year back from the company. It works a little bit differently than that, but just know you are buying these companies in order to get access to their earnings per share, and you want to see those earnings grow. And why this is so important is you will often see the market value companies based on their earnings per share. This is a very common ratio we see called the price to earnings ratio, which I'll talk about a little bit later on in the video, but this is how companies are valued. It is the most common way to value the stock market. So generally, you want to buy companies with growing earnings, and in turn, that will cause their stock price to go up. So let's take a very simple example, something like Apple. So if you had bought Apple back in 2000, your earnings were around 3 cents per share. If you simply own those stocks since 2000 up until now, your earnings are now $6.50 per share. So we can see a massive increase in earnings per share, which as a shareholder, you are directly impacted by those growing earnings. And as a result, Apple's share price has gone up by 33,000% over that time frame. A single $10,000 investment in Apple back then will pretty much leave you retired right now solely off that single investment. Now, opportunities like Apple are quite difficult to find, especially back in 2000, but they do exist and they do create this type of wealth. So the stock market does contain thousands of publicly traded companies all over the globe, and the vast majority of them will be losers. In fact, most stocks lose money, but there are a lot of companies that have created generational wealth for investors. So now that we have a basic understanding of what the stock market is, we can go into how simple earnings growth can compound over time and generate monumental amounts of money. I mean, the Apple example is a very good one. And the element of compounding in its simplest form possible is the idea that your returns start to earn returns. So let's go over this in a very basic example. Let's say you have $100 and that investment earns you 10% a year. So after year one, we will have $110 because that is 10% of 100. Now after year two, we will have $121 because what has happened is that $110 that we had at the end of year one, that $10 that you earned is now going to start earning returns as well. So we look at the total returns from each year. We earned $10 in year one and we earned $11 in year two because we could start earning from that previous amount we earned in year one. So this really doesn't seem like anything groundbreaking, but this ends up snowballing. It starts, as something small, and as it continues to grow, it rolls into something much, much bigger. Because even if we take that simple $100, after 10 years, it's worth $259. And after 30 years, it's worth $1,745. And if we think about the fact that, if we're doing this every single week, we're putting $100 in every single week, we can truly see how this can build up to monumental amounts of money over, longer periods of time. And if we do this with $200 a week, $300 a week, $400 a week, whatever we're comfortable with, we start to get a better idea of how game-changing investing is overall. So now you've got a really good idea that, if you stick around, watch this entire video, in 30 or 40 years, if you follow these strategies, you're probably going to have a ton of money. I think it is really important to understand those concepts because when we actually take this long-term mentality and we acknowledge that it exists, we begin to understand that investing is a very patient game. What you will get if you skip the first portion of this video and you don't really understand this concept, you're going to buy a bunch of stocks, you're going to get impatient that they haven't returned you a ton of money over the course of 6 months, over the course of a year, and you're going to sell them or you're going to try to take on heightened risk. Like what you need to understand and what the first portion of this video explains very well is that this is a long-term game. If you are interested in making a quick buck, you will fail. This video is primarily for investors who are interested in starting now to reap the benefits in 2 decades, 3 decades, whatever it may be, because realistically, that is how long it takes to actually reap the benefits from the markets. So now we're coming up to quite possibly the most confusing part and the part that I'm going to really narrow down here so you have a very good idea by the end of this segment, and that is what exactly to buy. Like I'd mentioned earlier in the video, there's thousands of publicly traded companies, 6,000 plus, I would say, in North America. So once we factor in those publicly traded companies, we then start to get into the fact that you can buy fixed income, which I'll get to in a bit, but let's just say there's tens of thousands of bonds on the market today. So we're now sitting at, 16,000 potential options for us to invest in. Looking at all these tickers, looking at all these options can be overwhelming at first, but it's really not that difficult. And just stick around and you'll understand why. Right now, investing probably feels like you're walking into a supermarket with a blindfold on, you got no list, you don't know what you want for supper, and you're just kind of winging it. Whereas, after this segment, you're going to have a precise list of ingredients and you're going to know exactly what to look for. So first things first, stocks. So these are publicly traded companies that exist on the market. When you buy them, you are getting partial ownership of that company. Now, these fluctuate in price based on supply and demand. If there are more buyers for a particular stock, there's more buying pressure, the price will go up. And if there's more selling pressure, the price will go down. This is truly a supply and demand market, and stocks can go up for no particular reason at all, and stocks can go down for quite possibly the most confusing situations you can think of. But this is the most popular way people are investing in the markets right now. When you are buying a stock, your profits or losses on that investment are directly tied to that company itself. So exchange traded funds or ETFs. If we think of a stock as a t-shirt, and we think of an ETF like your entire suitcase that you packed going on vacation. It's stuffed full. It contains a wide variety of t-shirts, so a ton of different investments. This is an ETF. So you are not relying on a single t-shirt, in this case, a single stock to drive your returns. Instead, you're buying an exchange-traded fund which carries 50, 500, 10,000 different investments inside of it. And one of the main reasons people do this is if you're buying an individual stock, or in this case, a t-shirt, and you tear it, it's wrecked. I mean, there's nothing else. If you only have one, there's nowhere else you can go. Whereas with an ETF, you got a ton of t-shirts inside there. So the fact that one is ruined won't really, ruin your vacation. And this is a prime reason why people own ETFs, or exchange traded funds, because if one stock inside that large basket fails, it's very unlikely to have a material impact on your investment portfolio. Now, bonds, or many people will refer to them as fixed income. So when we think of a stock, like we are giving the company money and in return we get ownership of that company, a bond we can think of as us loaning the company money. We get no direct ownership of the company. Instead, we're giving them, let's say, $10,000, and that company says, I will pay you a 5% interest rate every single year, and then when the bond matures or the loan ends, I will give you back your principal. So I mean, a very simple example of this, let's say you buy a $10,000 bond that has a 5% coupon with a 5-year maturity, meaning the loan ends in 5 years. What will happen is you will be paid $500 a year, and then after the end of 5 years, you will get your $10,000 back, and your total amount you have received from all of this would be about $12,500 for total profits of around $2,500. Generally, stocks have outperformed bonds. However, there is certain periods where bonds have outperformed, but generally, they are the much lower risk element of investing. You will not earn as much, but you are not putting as much at stake, I guess I would say. Overall, companies need to raise money in order to fuel future operations. And in this case, they do so in two ways. They either issue debt or they issue equity. Equity being that stock element, and debt being either actual debt from a bank or a bond issued to an investor. So these are the two most basic investments you're going to get on the markets, and they are the two largest markets in the world, arguably. This is where you're going to see most of the money. And keep in mind, there are other types of investments like GICs here in Canada, certificates of deposit in the United States. These are more so on the side of short-term savings vehicles. So for the purpose of this video, I'm going to stick more along the lines of stocks and fixed income. And actually, I'm more so going to focus on that stock element because for beginners, this is largely going to be what they are investing in. The good news is you really don't need to be an expert to get started with all of this, with any of these types of investment options. I mean, back when I started, I had a general idea of what a stock was, probably about as much knowledge as you do now after watching this segment. And I still got started. As I worked my way through, I became a lot more comfortable. I learned a lot more, but a lot of people will kind of think they need to be an absolute expert before they start. And in the end, that, kind of makes it so they just don't start at all and just don't get this impression that you have to do this. I mean, if you have a very generic understanding of what a stock is, what an ETF is, what a bond is, you can get started. So don't kind of be overwhelmed by all the information and just kind of give up. So buying stocks seems simple enough, but you just can't go somewhere, go to your local grocery store, go to your local supermarket and buy stocks. You need a very specific place to buy them, and those are called brokerages. So you can open brokerage accounts at practically any bank. So every single major bank, I mean, we can think of something like Charles Schwab in the States. We can think of something like Royal Bank here in Canada. They have separate brokerage elements where you can actually open up a brokerage account and buy stocks, buy fixed income, buy whatever you want. When we look to discount brokerages, which would be brokerages that are often, not brick and mortar facilities, but they offer lower commissions, kind of more attractive interfaces, slick mobile apps, things like that. In Canada, we can think of something like Wealthsimple or Questrade. And in the States, we get to give something like Robinhood or Webull. Those are very popular options. And today, the process of actually getting a brokerage set up is ridiculously easy, especially compared to when I started. I mean, you can go on a platform like Robinhood or Wealthsimple and have your account open in, a couple of minutes, and especially have, deposits in that account very, very quickly. I will drop a link in the description to some brokerage options you can get started with both Canada and the United States, which should help you get a fast track on this. But it is very, very easy to open up a brokerage and start buying stocks today. It has improved immensely from 20 years ago, that's for sure. So once you open that brokerage, there is a wide variety of accounts you use. And because this is a beginner video, I'm going to more so focus on the tax sheltered accounts, or the accounts that provide taxable advantages to investors. Now, why am I doing this? Because it's highly likely you should be taking advantage of those accounts first before you invest in a taxable account. So the first would be the tax-free savings account in Canada and the Roth IRA in the United States. So these two accounts are very similar. They allow investors to contribute room up to a maximum annual amount. They will not pay taxes on any gains inside of the account, and when they withdraw that money, they won't pay taxes either. For the majority of investors, especially if you are not a high income earner, these are going to be some of the best accounts to get started with. Now, if you're a higher income earner, you might find value in the RRSP in Canada or just a traditional IRA in the United States. Contributions to these accounts are tax deductible when you contribute to them, but you do pay tax when you pull them out. So in theory, especially with the RSP here in Canada, what you want to be doing is contributing at a higher tax bracket and withdrawing at a lower tax bracket in retirement. So if you are a high income earner, these might be more worth it for you, but you need to kind of analyze your overall situation. And finally, some other accounts that are kind of, not related to any of these, but do provide some advantages. We can look to a FHSA here in Canada, which is an account that operates very similar to the TFSA, but is aimed to help you buy your first home. It is a very beneficial account for younger Canadians looking for home ownership, so you can dig into that. And then we have 401ks in the United States, which is kind of an employer-sponsored plan where they will match your contributions. There's a lot of RRSP plans that do this in Canada as well, which can be huge advantages in terms of getting bonus money from your employer. So you've got these accounts open, and you're now actually fully ready to buy your first stock, your first ETF, whatever it may be. However, it is very important you don't just skip to this step, and instead you develop a strategy first. I actually cannot begin to tell you the amount of investors that I have dealt with over the years that, say sign up at Stocktrades, and they come to me, they ask about their portfolio. I look at their portfolio and it is a complete jumbled mess, because what they did is they did not figure out, first off, an investment strategy, second off, their risk tolerance. So they end up with a bunch of just random investments, random allocations all over the map. Their portfolio is underperforming, and I can guarantee you it is because they skipped this step. So the first step to an investing strategy is figuring out your tolerance for risk. And the vast majority of investors I have dealt with believe that their tolerance for risk is much, much higher than it actually is. What this ends up in them doing is they buy a bunch of high risk stocks. The market corrects, say 20%. And because they're in that higher risk area, they're falling 30, 40, 50%. And they kind of at that point truly realize what their tolerance for risk is, and it was nowhere near what they thought it was. I am a pretty firm believer that you find out your true tolerance for risk in falling markets and not rising markets. This is because markets can fall very, very, very quickly. Beginner investors will understand that during their first bull market, where, the common saying is the markets take the stairs up and the elevator down, meaning they go up very slowly over longer durations of time, but generally when they fall like straight down like an elevator. So I do tend to tell beginner investors, think of what you can handle without actually experiencing any of the market volatility, and maybe go a little bit more conservative with that. And the one reason I tell them this is your risk tolerance is kind of like, think of it as a thermostat. So if you set a thermostat too high and you get burned, there's really no coming back from that. Whereas if you set it a bit too low, you might get, you might be cold for a bit, but you can kind of adjust that upwards to a level where you can get comfortable. So it's always better to lean a little more conservative and then get more aggressive as you progress to kind of find that sweet spot, rather than going way more aggressive at the start and paying the price heavily. What happens if we get too aggressive is we end up making panic-driven decisions when the market inevitably draws down. We're down a whole bunch of money, more than we're comfortable with, and we end up selling those stocks or selling those other investments, resulting in permanent losses. So once you've actually figured out your tolerance for risk, you can begin to decide what you want to buy. So for example, somebody on the more conservative side might look to an index like the S&P 500, which contains the 500 largest companies in the United States, or they might buy a TSX index fund like the Toronto Stock Exchange, which contains a lot of blue chip Canadian companies. Whereas somebody with a bit more of an aggressive risk tolerance, one that is willing to take more risk for higher returns, might look to an index like the NASDAQ, which is an index that contains a lot of technology stocks, a lot of growth stocks, and one that has historically provided higher returns but has much larger drawdowns when a bear market inevitably hits. And if one is looking towards ETFs, there are plenty of different ETFs that provide different investment solutions depending on your risk tolerance. For example, there are all-in-one funds that are 100% stocks, whereas there's other all-in-one funds where you can go 80% stocks and 20% fixed income. Remember when we talked about bonds earlier on in the video, they are the lower risk asset, lower returns, but also lower risk of losing your principal. So you can go 80-20, you could even go 60-40 or 50-50. So ETFs have come a long way in terms of having products that really align with people's risk tolerances. Now, if you're going the individual stock route, this is an option that can work out very well, but does require a lot more work. Building out a individual stock portfolio might require you to research and buy 15 to 25 stocks depending on your overall risk tolerance. So somebody with a lower tolerance for risk might look to, more stable blue chip dividend payers, whereas somebody who has a higher tolerance for risk might look to a lot of high growth technology companies, but has to be willing to accept the fact that these stocks will go down a lot more in a bear market than those stable options. It is also important to understand that no matter what your strategy is right now or what your risk tolerance is right now, that you don't believe that it will be like this indefinitely. Younger investors can naturally take on more risk because their time horizon is longer. When your time horizon is 30 years, you don't really care, at least you shouldn't care, that the market could crash. In fact, it would just allow you to buy stocks cheaper. But if you're closer to retirement, 5 years away, it might feel a lot riskier taking on added equity risk when a market crash in the next year or two could actually cost you years of retirement. You may be forced to work longer. So once you've developed your overall risk tolerance, just make sure you're consistently monitoring it to make sure that it still suits your overall goals. So let's go over some basic market terminology that will kind of help you understand the lingo better, maybe help you navigate your decisions better. And then after that, we'll get into actually researching stocks and building out a portfolio. So if I wanted to, I could probably make a multi-hour-long video explaining a lot of this terminology, which, if you're interested in that, drop it in the comments down below. I will consider creating a video that goes over a lot of these terms in depth, but in this section, I'll just do a few so that you don't get overwhelmed, and I'll also lead you to a bit more advanced metrics on each of these that if you want to do some more digging on your own, you can. So the first one would be price to earnings ratio. So if you remember earlier on in the video, I mentioned that stocks are primarily valued based on their earnings. The market values companies as a multiple of their earnings. So the formula for price to earnings is very simple. We take the stock's share price and we divide it by its earnings per share. So a stock that is $100 but has earnings per share of $5, we divide that 100 by 5 and we get a price to earnings multiple of 20. So whenever you hear somebody say multiple or valuation multiple in terms of PE or price to earnings, this is what they mean. This company would trade at 20x earnings. This is the most common investment ratio you will see on the market, and there is two ways to look at it. The first one would be the trailing or TTM, trailing 12-month price to earnings. So this is the price to earnings ratio based on what the company has earned over the last 12 months. So if we think of that past example, we look at a $100 share price, $5 in TTM earnings, and we have a price to earnings multiple of 20x. Now, when we look to a forward price to earnings multiple, which is what the company is expected to earn over the next 12 months, we get a different number. Let's take, for example, the same company is expected to earn $7.50 next year. So we would take that $100 share price, we would divide it by $7.50, and we get a forward price to earnings multiple of around 13x. So in general, you do want to see the forward price to earnings lower than the trailing price to earnings. If it is the reverse, if the trailing is lower than the forward, that means the company's earnings are expected to decline, and generally we do not want to see this. So if you're looking to dig deeper in this regard, have a look at the price to free cash flow ratio, or the PEG ratio. So the next one would be earnings per share, and this metric is relatively easy. I have focused on it at the start of the video, but this is effectively the company's profits divided by the amount of shares that are openly traded on the market. So if a company has 1 million total shares available to trade and they have profits of $10 million, their earnings per share would be $10. Ultimately, we want to own companies that are increasing earnings per share. So market capitalization would be the next one, and this is effectively the price tag that the market puts on a company. If you've seen a recent headline, let's say, just for example, Nvidia becomes a $4 trillion company, what they are referring to is the market cap. They're saying the market capitalization of Nvidia has gone over 4 trillion. And the market cap is a very, very easy calculation. It is effectively the total shares available to trade on the market multiplied by the price per share. So if a company has 1 million shares available to trade on the market and a share price of $10, they will be worth $10 million. So price to sales is the next one. And this is a ratio that I don't really look at all that often, but it is still, it's a relatively good benchmark in terms of what a company is worth, especially when we're comparing it to similar companies. So let's say we're comparing an Alphabet to a Microsoft. So this is a company's market capitalization relative to the revenue it generates. So price to sales would effectively mean market cap to revenue. So if we have a company that has a $10 billion market cap and they have $5 billion in sales, they are trading at 2 times sales. So the next one is EBITDA, and this is one I was going to leave out, but we're seeing brought up more and more these days. So I do believe it is a number that you do need to get a pretty good understanding on. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So in a nutshell, what it is telling you is how profitable the core of the business is before we factor in things like taxes owed to the government, before we factor in things like debt, because the I in EBITDA stands for interest on the debt, and it also factors in profits before things like the wear and tear or the depreciation of the equipment that it uses to generate that revenue. So let's think of, a very basic business model like a restaurant. EBITDA would tell you what the company's profits are before it's paid the interest on its loans or before it's paid for the depreciation of its kitchen equipment, pots and pans, stoves, fridges, coolers, things like that. So it kind of helps you judge the profitability of the underlying business. Now, don't get me wrong, things like interest on loans and the equipment you need to run the business are definitely real expenses, but the EBITDA just kind of gives you a bird's eye view on how successful the core operations are before you factor in these other costs. So a dividend. So as I had mentioned numerous times throughout this video, when you buy a share of a company, you are entitled to the proportion of earnings that share gives you. In some situations, they might decide to pay out what is called a dividend to shareholders. So generally, a management team of a company will decide what the dividend is, when it will be paid, and as a shareholder, you benefit from this. So let's just say a company has earnings per share of $4 and management believes they could pay out a $2 per share dividend. So this dividend would be issued to shareholders and it would simply be paid into your brokerage account. So the dividend yield would be how much you're expected to get paid. So let's say the example above, the one that is issuing a $2 dividend, let's say they trade for $100 a share. That yield would be 2%. You're taking your $2 dividend and dividing it by the $100 share price. You're multiplying it by 100 and you're getting the total yield. So if you're looking to dig a bit deeper here in regards to dividends, look for terms like the payout ratio and the dividend growth rate. So some other quick lingo that I know you're going to come across, and you should probably get an idea as to what they mean, but a bull market, this would be a market that is generally rising. We do see more bull markets historically than we have bear markets. On average, I believe a bear market comes every single 5 years, and a bear market is when the stock market declines by 20% or more. If the stock market has not declined by 20%, but more than 10%, we get into what is called a correction. So a correction in the markets is a dip between 10 and 20%. So a very common term used during market dips is something called buy the dip. So this is a term that has been coined by a lot of retail investors that pretty much says when the stock market dips, when prices fall, you buy that dip, generally to get cheaper prices so that you are making more when the market inevitably rises again. And then there is another common term you're going to hear a lot, and that is dollar cost averaging. And that is when you don't necessarily buy the dip. Instead, you get a set amount of money you want to invest at a set interval, and you just stick to that strategy no matter what. So in some people's case, that might be contributing every single Monday at the start of the week and buying stocks every Monday. For some, it might be buying every month. For some, it might be buying every couple of months. So now that we have all that lingo down, all the basic fundamentals, we can begin to look at our first stock. And the one thing I will say that will make your life a lot easier is to find a stock screener that will help you kind of sift through information in regards to stocks. So I run a platform called Stocktrades Premium. I have a custom screener, one that I utilize to custom grade around 6,000 stocks in North America, but a lot of screeners, your brokerage will have a relatively basic screener as well, but you do need a screener or else the information will just be simply overwhelming. So once we get this screener set up, we can kind of, utilize the metrics that I went through in the previous portion of this video to kind of narrow down potential stocks that we want to look at. We can use this data to kind of take a, 6,000 plus publicly traded entities, and we can get it down to maybe a dozen. And we can do this by setting parameters. Like, for example, we don't want the price to earnings ratio to be over 20. We want something under 20, or we want the earnings per share growth rate to be at least 20%. So we're going to narrow down our focus on a very select few companies by doing this. And this is where a screener can literally save you dozens of hours. And once we have that handful of companies, we can now begin to investigate each individual company and see if they check off the boxes or see if, we don't really like them. And for the sake of this video, I'm going to just kind of come up with Alphabet, which is Google's parent company, as one of the companies we've identified as a strong option. If we come over to the screen here, before we even get into all this data, and we can see common metrics that I had mentioned, the market cap is here, the PE ratio is here, and we can see this PE forward ratio, as I had mentioned before we even get into any of these numbers here, we need to understand what Google does as a business. It is very easy to get tricked into just buying blips on a screen, tickers on a screen, and we don't really understand the business itself. These are publicly traded companies that operate in the real world, and if we do not understand how the business actually functions, and instead we just look at them from a numbers perspective, we will end up making a ton of bad investments. So how can you get an idea as to what a company does? Well, a lot of these websites will have descriptions, as you can see here. Alphabet is a holding company which engages in software, healthcare, transportation, other technologies, Google services, Google Cloud, Android, Chrome, they run browsers, things like that. You can actually probably utilize a platform like ChatGPT to come up with a very, in-depth overview on what the company does. We can come to a company's earnings report to figure out what they do. We can come down here. We can see that Google reports Google search revenue. They own YouTube. They have YouTube ad revenue. They have Google Networks, they have Google Advertising, they have Google Cloud, they have a lot of AI exposure these days. But before you get into these numbers, you want to be digging in to what the company does. And when you have a good foundation of that, then you can start to dig in to, actually how the company is growing. And depending on what data platform you have, this will be shown in different ways. But I can come right down here and see that Google over the last 5 years has grown revenue by 16.7%, which is pretty good, and they've grown earnings per share by 26.7% a year over the last 5 years. So this is a very impressive growth rate, and as we can see by the chart, there is a reason why Google's share price is up, 839% since 2015. So overall, we'll look to numbers like the PE ratio. It's trading at 27x earnings, and this might not mean that much to you right now, but eventually you're going to get more comfortable with these numbers and, more used to judging what is fair value, what is good, appropriate value to you. These growth rates, you might not know exactly what a 26% annual earnings growth rate is, but I'll tell you right now, very, very few companies can do this over a 5-year period. That is an exceptional growth rate. So once we get used to these numbers, once we research these companies, we can begin to see as to whether or not they're buys. And it comes down to a certain level of intuition in the fact that you are buying businesses here. So don't get caught up in the numbers. If you're looking at a company like Google, YouTube is exploding in growth. You're watching this right now on YouTube. Google is exploding in terms of growth, in terms of AI search opportunities, things like that. Sometimes we focus too much on the numbers when in reality, we should just be focusing on the underlying business we're going to buy. Now, before we move on, the one thing I will say is the vast majority of your time spent, analyzing your basket of screened stocks, you will come up empty-handed. The vast majority of stocks are not worth buying on the markets. So you might get 12 stocks, you might look through all of them, and you might find that all 12 are not worthy of your investment. And that is perfectly fine. What a lot of people will get caught up doing is they will put a lot of time and a lot of resources into researching these stocks. They don't want to come out empty-handed after, 20 hours of researching these companies. So they buy something because they just feel it's good enough for the time they put in. I'll give you a very popular quote from Warren Buffett, who is probably the greatest investor of all time. And he says that investing, if every retail investor was given a punch card in terms of investments, they would probably do a lot better. And what he means by this is you would get a punch card with 20 opportunities. Every stock you buy, you had to punch that card. And once you bought 20 stocks, you would run out. You could not buy any more. If investors were given this punch card, they would end up buying a lot less stocks because it is a finite amount of options you can choose. Once you choose 20, you're done. So this should be the mentality that you should take. So we're getting towards the end of this guide, but we're not done yet. The next step we want to do is actually build out our portfolio, or at least map out a plan to build out our portfolio. So the one thing I do like to say is that a portfolio should be greater than the sum of its parts. And what I mean by this is all of your individual holdings, whether they are stocks, whether they are ETFs, are way more powerful than just simply owning a individual holding. And how you can aim to do this is by diversifying your portfolio across multiple sectors of the market, across multiple industries, and you want to be seeking out particular leaders in each area of the market, let's say utilities, technology, healthcare companies, consumer discretionary, consumer staples, things like that. And you either want to be identifying leaders in that area, or you want to be just buying ETFs, broad market focused ETFs, which will give you exposure to all of this. Now, if you buy a broad market ETF, you will underperform the market. You won't underperform the market by much, but let's say if the market returns 10%, if you own a broad-based ETF, you'll return probably 9.8, 9.9%, give or take. This is because with an ETF that holds the overall market, there's going to be fees for managing that ETF, and ultimately that is taken out of your overall returns. Whereas if you own individual stocks, there is a chance that you can outperform the market. You can earn, say, 15% while the market earns 10%. Now, this is very difficult. The vast majority of investors will fail at doing this, but it is something that a lot of people try nonetheless, and it's something a lot of people do just because of their love of researching and identifying individual businesses to buy. The choice of what to do is ultimately up to you. Now, when we come to building a portfolio, there are two main types of risk. One is called systematic risk, and this is risk that it does not matter what you do with your portfolio, you simply cannot diversify from. This is a level of risk that you take on just owning investments, period. So let's think of something like large inflation. We can think of something like wars. If we look to past events, we can look to things like the COVID-19 pandemic, or let's say 9/11 that caused the markets to, have a lot of volatility. These are events that you cannot foresee, you cannot mitigate against. So that is called systematic risk. Now, the other level is unsystematic risk, and this is risk that you can diversify away from. So think of things like a product recall against a specific company. If you own a lot of that specific company, it could have a detrimental and permanent effect on your portfolio if that product recall is large. Let's say, for example, you own an automobile company that had a faulty part that caused a lot of collisions, a lot of, let's say, even potentially deaths, which results in a lot of lawsuits, things like that. If you have a large position in that company, it can actually end up permanently damaging your portfolio. But how you can diversify away from this is owning a larger basket of investments so that that particular company does not have a large influence on your portfolio. Generally, a well-diverse portfolio will contain around 20 stocks. There's a lot of studies that kind of highlight we don't, mitigate unsystematic risk much more if we own more than 20 stocks. Now, that is not to say that owning more than 20 stocks is not a negative thing. It just doesn't really reduce your risk in terms of diversification. Now, whether you are choosing ETFs, stocks, or a mix of both, the most important thing about your portfolio is that it is aligned properly to your goals and to your risk tolerance. The best portfolio for you is not necessarily the one that looks the best on paper. It is the one that you will actually stick with. It is the one that you will not panic sell during a market drawdown. So that's pretty much it for the guide, but the one thing I'm going to conclude this video with is some very common investor mistakes that I see over and over again. These are some of the most common mistakes I see among beginner investors. These are ones I made numerous times when I was first starting out. And if you watch this section, it's probably going to save you some time, and it will probably save you some money, because ultimately I had to learn these lessons the hard way, and that was losing money in order to learn from them. So the first one would be making emotional moves. You need to have ice in your veins when it comes to investing to not make mistakes based on your emotions. When stocks are rising at a very fast rate, people tend to get a sense of fear of missing out. They'll buy stocks at all-time highs. And when stocks get, very low during a bear market, they're dipping and dipping and dipping. People tend to panic and they tend to sell. And that's not to say that stocks at all-time highs, some particular stocks won't still be buys. And that's not to say that stocks at, yearly lows might not actually be sells, but you need to be making this from a business perspective and not a emotional human perspective. And this doesn't even come from an element of single stocks. People can panic sell ETFs as well. So the second biggest mistake I see among beginners is chasing high dividend yields. And investors, particularly newcomers that have not managed a portfolio very long, absolutely love dividends. And why is this? Well, it is realized returns. That dividend is in your brokerage. It's safe. Even if the market crashes 20, 30, 40%, the next day you got that dividend. It's a realized return. And it's kind of an element of a bird in the hand is worth two in the bush. You like that money now instead of waiting for that money in the future. So naturally, investors aim to acquire companies that pay higher yields. However, you might get away with this over the short term, and there are certainly some companies or ETFs that are designed to provide higher yields, but what might end up happening is you'll get hit with dividend cuts or you'll get hit with distribution cuts, and ultimately that really could hurt your portfolio from a pricing perspective. It is very likely, if you're watching this video, you have a 20, 30, 40-year time horizon. So you should not really care where your returns come from, whether they come from an increase in share price or whether they come from dividends. But chasing yield is one of the surefire ways to get burnt in the markets. So the third and final one I'll go over, and this is one of probably the most common one I see, and probably the most common one that leads to severe underperformance in relation to the overall markets, and that is trying to time the market, buy low, sell high. And one of the number one quotes I give to my Stocktrades Premium members when they ask a question like this, should I sell now and buy back later when it dips, is there's two options. You're either going to get lucky or you're going to be wrong. And we really never want to depend on luck or circumstances to drive our portfolio returns. What we want to do is we want to buy strong companies and hold them for the long term. There has been a century's worth of data that highlights that timing the market does not work. In fact, you are expected to underperform the market severely if you attempt to do this. Now, you could get right a couple of times, which will give you a false sense of confidence, but over the long term, it is impossible to outmatch hedge funds with multiple $billion worth of assets under management. Trading algorithms these days are super sophisticated. You're not going to beat these people with, a beginner portfolio. Just buy stocks, hold them for the long term, and don't worry about whether or not the market dips 20% tomorrow, because all that really does is allows you to buy stocks at cheaper prices. You shouldn't be concerned with where the market is going over the next 6 months, 1 year, 2 year. You should be considering where it is going over the next 10-year, 20-year, 30-year period. And I can guarantee you, 10 years from now, you will not remember a price you paid for a particular stock, especially if it is done well. So everybody, that is it for the video. I really hope this guide helped you. I hope you now have a basic understanding of the stock market and you're finally able to dip your toes into the markets overall. If you have any questions, feel free to drop them in the comments. I'll do my best to answer. And if you like this video, this mega sized video, the only way I will know is if you head down and like the video, subscribe to the channel, and I will make more videos like this if I get enough traction on them. And as always, there is that cheat sheet down in the description, which will kind of summarize this video up for you. You can get a very, instead of coming back and referring to this video over and over again, you can get that cheat sheet. You'll have it in a couple page PDF and you'll be able to navigate things much easier. And as always, everybody stay tuned for more great investing content.